Ever wondered if that cash investment your bank or brokerage keeps mentioning is just a fancy name for a regular savings account? You're not alone. It's easy to get lost in the financial jargon, and understanding where your money is actually working for you is crucial. Think about it. You diligently set aside a portion of your earnings, hoping it will grow steadily and securely. You see terms like high-yield savings and cash management accounts, and then someone mentions a cash investment at Fidelity. Naturally, questions arise. Are these all the same thing? Do they offer the same level of access, the same potential for growth, and the same risks? In today's deep dive, we're tackling this very question. Is a Fidelity Cash Investment the same as a savings account? We'll break down the fundamental characteristics of each, explore their similarities, and, more importantly, their key differences. By the end of this video, you'll have a much clearer understanding of where your cash could be best positioned to meet your financial goals. Let's start with the familiar, the savings account. Most of us have had one at some point. It's the basic building block of personal finance, a safe place to park your money for short-term needs or as an emergency fund. Savings accounts are offered by traditional banks and credit unions and are typically insured by the Federal Deposit Insurance Corporation, FDIC, up to $250,000 per depositor, per insured bank. This one provides a significant level of security and peace of mind. 1. FasterCapital.com. FasterCapital.com. Key features of a typical savings account include accessibility. Funds are generally easily accessible. You can usually make withdrawals and deposits in person, through ATMs, or online. Interest. Savings accounts earn interest, although the rates can vary significantly depending on the institution and the type of account. Traditionally, interest rates on standard savings accounts have been relatively low. Low risk. Due to the FDIC insurance and the nature of holding cash, savings accounts are considered low-risk investments. Your principal is typically safe. Limited transactions. Some savings accounts may have limits on the number of withdrawals you can make per month. Now, let's turn our attention to a Fidelity Cash Investment. This term might sound a bit more complex, and that's because it often encompasses a broader range of financial products offered by Fidelity Investments, a large brokerage firm. When someone refers to a Fidelity Cash Investment, they could be talking about several different options, including Fidelity Government Money Market Fund, SPACs, Fidelity Treasury Money Market Fund, FZXX, Fidelity Cash Management Account, Certificates of Deposit, CDs. So, are these cash investments the same as a savings account? The short answer is no, not exactly, but there are some overlaps and nuances we need to explore. Here's a breakdown of the key differences. 1. Insurance. Savings accounts, typically insured by the FDIC up to $250,000 per depositor, per insured bank. Fidelity money market funds, like SPACs and FZXX, these are not FDIC insured. However, government money market funds are generally considered very low risk due to the high credit quality of the underlying U.S. government securities. While it's extremely rare for a government money market fund to break the buck, fall below $1 NAV, it's not impossible. Fidelity Cash Management Account. The cash balances in this account are often swept into FDIC-insured banks. Fidelity provides information on the program banks and the extent of the FDIC insurance. Fidelity CDs. These are FDIC insured up to the standard limits through the issuing bank, not directly by Fidelity. 2. Returns, interest/yield. Savings accounts, interest rates can vary widely. Traditional savings accounts often offer very low yields. High-yield savings accounts offer more competitive rates but can still fluctuate with market conditions. Fidelity money market funds. These offer yields that fluctuate based on short-term interest rates. Historically, their yields have often been higher than those of traditional savings accounts, especially in periods of higher interest rates. However, this is not guaranteed and can change. Fidelity Cash Management Account. The yield offered is typically linked to money market rates and can be more competitive than a standard checking account. Fidelity CDs offer a fixed interest rate for a specific term, which can be attractive if you anticipate interest rates falling. 3. Liquidity and access. Savings accounts, generally highly liquid, allowing for easy withdrawals and deposits. Fidelity money market funds, highly liquid. You can typically buy and sell shares easily within your Fidelity brokerage account. Fidelity Cash Management account, designed for everyday transactions with debit cards and checks, offering high liquidity. Fidelity CDs, less liquid than savings accounts or money market funds. Withdrawing funds before the maturity date usually incurs a penalty. 4. Account type and purpose. Savings accounts, primarily designed for saving and holding cash securely. Fidelity money market funds, technically mutual funds, considered a type of investment. They are often used as a temporary holding place for cash within a brokerage account before it's invested in other securities. Fidelity Cash Management account blends features of checking and savings accounts, offering transactional capabilities along with potentially higher yields. Fidelity CDs, fixed-term investments designed for a specific savings goal with a predictable return. 5. Minimum balances and fees. Savings accounts, minimum balance requirements and fees can vary depending on the bank and account type. Some may have low or no minimums and no monthly fees. Fidelity money market funds typically have no minimum investment requirements or management fees for retail investors. Fidelity Cash Management account generally has no monthly fees or minimum balance requirements. Fidelity CDs may have minimum investment amounts. Ultimately, while a Fidelity Cash Investment and a savings account both serve as places to hold your money, they are not identical. They come with different features, levels of risk and insurance, potential returns, and intended purposes. Understanding these distinctions is crucial for making informed decisions about where to keep your hard-earned cash. With that said, thanks for watching and until next time.